So in this video we will be solving another full length question on depreciation, and the question that we will be doing is from 7110 variant 21 October November 19. Question number is 2. So let's begin. The question says Rod's financial year ends on 31st December, very good, and on 1st of January 2020 Rod will purchase a new delivery vehicle for his business, right? So this is what? A purchase of a non-current asset. The details are as follows, right? The cost of the new delivery vehicle is $12,000. The estimated economic life is 3 years and the residual value is $1,500, right? So very important information: cost, life and residual value. It further says that Rod is undecided whether to charge depreciation on the new delivery vehicle by using the straight line method or the diminishing or reducing balance method. So he isn't sure yet. If he decided to use the diminishing or reducing balance method, this would be at a rate of 50% per annum, right? So we know that if we are asked to calculate depreciation using the reducing balance method, then we'll use the rate 50%. And if straight line method, then we have the cost, we have the life and we have the residual value. Now the first requirement is explain the term depreciation, and for how many marks? For 2 marks. Right. We can write that depreciation is a fall in the value of non-current asset over its estimated useful life and the reasons for depreciation as well, right? So let's write that down. So even after writing the reasons, I had more space, so I added one more point, and that is the concepts that ask us to apply depreciation on the non-current asset, and these are what? The matching and the prudence concept, right? We know that what does matching say? Matching asks us to match the benefits which are being earned from the use of non-current asset with its cost, right? So every year we charge depreciation to adhere with the matching concept, and prudence asks us to not to overstate our profits. So if I am not calculating depreciation, I am not showing a fall in the value of my non-current assets, I won't be applying the prudence concept then, right? But it's up to you. Even if you don't write the concept, you will still get 2 marks if you explain these 2 points properly. That what is it? It is a fall in the value of non-current asset over its estimated useful life, and if you have the space, you can write the reasons as well. For instance, due to wear and tear or due to the usage of the asset with time, obsolescence, inadequacy, etc. Right. Now let's move to part B. Part B says calculate the depreciation which would be charged on the new delivery vehicle for each of the years 2020, 2021 and 2022. Using what? Using straight line method as well as the diminishing or reducing balance method. What else are we told? We are told that insert your answers in the table provided, right? So this table for these 3 years, and use the space provided on the next page to show your working. So we have the working area over here. Right. So for a straight line, we know that we will be using this information: life, cost and the residual value, and for 3 years we have to calculate depreciation using these 2 methods. So let's begin with the straight line method first. So what is the formula to calculate depreciation under straight line method? We take the cost, we subtract the residual value from the cost, and we divide it with the number of years or the life. So in this question, what is the cost? The cost is $12,000, the life is 3 years, and the residual value is $1,500. So 12,000 less 1,500 divided by 3 will give me a depreciation of $3,500, right? So this is the depreciation for which year? For 2020, 2021 or 2022. This is the depreciation for all of these 3 years, right? The same depreciation will be charged if Rod is using the straight line method to depreciate his delivery vehicle, right? Because under straight line method, the depreciation is applied on the cost using the same formula every year. So this is the depreciation charged every year using the straight line method. So let's write that down. 3,500 will be charged every year. right? Now let's move to the diminishing balance method or the reducing balance method. We know that we charge depreciation on the net book value if we are following this method. So for 2020, first of all we'll take the cost. The cost is what? It is $12,000. Then we'll depreciate the cost by 50%. This was the rate given to us. So 12,000 multiplied by 50% is 6,000, and the net book value will also be 6,000. Right? So this is the depreciation charge in the first year, and that is $6,000. Let's write that down, 6,000. Now for year 2021, now will this depreciation remain same, 6,000 again? No. In 2021, we know that depreciation will now be applied on the net book value. So net book value is how much? It was $6,000. So 50% of 6,000 will be $3,000. This will give us a depreciation of again 3,000, and the net book value will also be same. So this is the depreciation for year 2021. And then for last year 2022, depreciation again on the net book value. So 50% multiplied by 3,000, that would be 1,500 depreciation and 1,500 of net book value as well. So every year it is reducing by how much? By 50%, because this was the rate. Right? Using straight line method, the depreciation remains same every year. However, with reducing balance method, it keeps on decreasing. We are done with part B. Let's move to part C now. Right? But before part C, there is some information. What is that? It says that Rod has estimated the following to help him decide which method of depreciation he should use for the delivery vehicle. So he has estimated some of the costs related to the delivery vehicle, which will help him in deciding that whether he should adopt the straight line method or the reducing balance method. Very good. What is year? Same years are given, 2020, 21, 2022, and the relevant information. So what is given to us? The market value of the delivery vehicle at the end of each year. So the market value at the end of first year will be 6,000. Right, it will reduce by how? By half of it. Then again 3,500 will keep on reducing, and then 2,000 by the end of year 2022. Then there will be some annual maintenance costs as well related to this delivery vehicle. However, there will be no cost in the first year. Very good, because it was the first year of it being operational. Then second year 3,000, and third year it will increase by 1,500 more, so it would be $4,500. Now let's read the requirements. Part C says, explain one advantage of using the straight line method to depreciate the delivery vehicle. If Rod is adopting straight line method to depreciate his delivery vehicle, then what would be the advantage of that? Right. And for how many marks? For 2 marks, we have 5 lines for that. Okay. So we know, we have discussed this earlier as well, that what is the advantage of using straight line method of depreciation? Well, one major advantage is that the depreciation calculated every year is same, right? Or you can also say that it is constant. You don't have to do rigorous calculations every year, unlike that we do in reducing balance method to charge depreciation every year, right? But right now we have to write according to or relevant to the delivery vehicle that is given in the requirement, right? So how can we write this? We can say that so if it is expected that the delivery vehicle will be giving same benefit every year, right, due to its usage, so it would be relevant to charge depreciation by using the straight line method. If the benefits earned from the use are equal every year, then he can use the straight line method, and that would again not distort his profits, and it will give constant depreciation every year, right? So let's write that down. Okay, so you can also explain like this, that what have I written? If the delivery vehicle is expected to give same benefit every year, then straight line method of depreciation will help Rod charging equal or constant depreciation against the usage of that delivery vehicle throughout its useful life, right? So since he has made some estimations over here, if he is expecting that the delivery vehicle will be used in such a way that it will give equal benefit, so just charge an equal amount of cost against the usage. Right now, what will be the benefit of this? This will not distort the profits, and it will be an easy way to charge depreciation every year. If you have the space, you can write this much. If you don't have the space, if you write a bit bigger than my handwriting, then of course you can summarize this point as well, right? But make sure that you put across your point clearly. Now let's move to part D. It says that explain one advantage of using diminishing or reducing balance method to depreciate the delivery vehicle. Now if Rod is using the reducing balance method, what would be the benefit of that? We solved part B and we concluded that the depreciation every year using reducing balance method would be 6,000, 3,000 and 1,500 for each of these years, right? Now, if we just compare these figures, right, 6,000, 3,000, 1,500 with the market values given to us before part C. Now, can we say that these market values at the end of each year are very much closer to the net book values that we calculated when we were solving it for reducing balance method? See, in first year the net book value is 6,000, right? And the market value is also 6,000 in the first year. In the next year it is 3,500. The net book value is 3,000, again a much closer figure. And in the last year the net book value is 1,500 and here it is $2,000. So don't you think that if he adopts the reducing balance method, the net book value will be very much closer? The net book value is what? That if I just go in the market and I want to sell it, what would be the valuation of my non-current asset at that point, right? How much can I again earn or get the benefit from the sale of that non-current asset? So the net book values are very much closer to the market values if reducing balance method is used. So we can say that the calculation of the net book values will be quite accurate if we adopt the reducing balance method, because again it will be closer to the market value. One more benefit of this is that we know that under reducing balance method we charge higher depreciation in the early years of that non-current asset. Why is that so? This is because in the early years we expect the non-current asset to give more benefits, right? Because it is new at that time. Now since we are earning more from the use of that non-current asset, therefore we charge higher depreciation in the early years. So higher benefits are equated with the higher depreciation charge. And when we are closer towards the end of its useful life, we are charging low depreciation, right? As we saw in the calculation as well, that as the years pass, we charge less depreciation, right? It keeps on decreasing because it is charged on the reduced net book value every year. So therefore, there is low depreciation in the later years of the non-current asset, right? Because it is then again giving us less benefit compared to its early years. So now how can we connect this point with the annual maintenance costs? We know that with every non-current asset there is depreciation, but depreciation is not the only cost that is expensed out in the income statement every year. There are repairs and maintenance charges or other charges or other expenses that help the asset keeps running every year. So we know that when the asset is new, there are almost zero maintenance charges in the early years of its life. Therefore, since it is giving us more benefits in the early years, we charge higher depreciation in those years as well. Because we know that as the asset will get old, it will get aged, there will be more maintenance charges in the later years of that use. And that is why we charge more maintenance costs in the later years but less depreciation or low depreciation in the later years, right? So therefore, in order to even out or in order to equate the benefits with the expenses, there is high depreciation in the early years but there is low maintenance charges in the early years. And in the later years, there is low depreciation because again the benefit that we will be earning from the use of that non-current asset would also reduce with age. So low depreciation in the later years, but high maintenance charges in the later years. So in this way, we will even out the expenses throughout the use of that asset in its useful life. So this is the benefit which Rod can avail if he uses the reducing balance method. So let's write this information in the space given to us. So how can we explain this? We can say that vehicles usually, as motor vehicles usually are depreciated using the reducing balance method. So vehicles usually have low maintenance costs in early years and they give more benefit in early years. Therefore, higher depreciation is charged in those years. And this will do what? This will offset the depreciation in the later years, as then there will be lower depreciation because it will be applied to lower net book value each year, but higher maintenance costs if reducing balance method is adopted. Of course, when you will be writing this point, you will be writing in your own words, but make sure that you explain in such a way that your point is put across very well. We can also say that if reducing balance method is adopted, then the net book values will be very much closer to the market values given to us in the question, which will again be a good thing, because then we will know that our calculations are very much accurate with the market calculations. Now, part E. Part E says Rod has been advised by a friend that he could use the revaluation method to depreciate the delivery vehicle as well. Okay, so revaluation method, right. Now, explain how the annual depreciation would be calculated using the revaluation method. So we have discussed that what is the formula to calculate depreciation under revaluation method. We know that we take the opening value of the non-current assets, we add the purchases during the year, and we subtract the closing value of the non-current assets at the end, right? And then whatever the figure comes, that is our depreciation. So we just have to explain this formula. If you have more space, or you can write this formula as well, right? So let's begin. Okay, so how can we explain this? We can say that under revaluation method, the closing value, right, the year-end value of the non-current assets is compared with the opening value of the non-current assets, and which also accounts for any purchases of that non-current asset during the year. So opening value plus purchases less closing value, compare means that we are subtracting the closing value, and then whatever the figure comes, whatever the difference, it represents depreciation for the year, right? Now let's move to part F. For part F we have some really interesting information, right? On 30th June 2019, Rod sold his old office computer, right? So this is a new non-current asset. All previous parts were related to the delivery vehicle. Now this is new, this is office computer, and he has sold that on 30th June 2019. The following information is available. Balances at 31st of December 2018, right? So what does they represent? They are the balances just 6 months before the disposal of this non-current asset, right? 31st December year end of 2018, and this asset is sold on 30th June 2019, so after 6 months. What do we have? We have the cost and we have the provision for depreciation to date, right? Till 2018, the old office computer has been depreciated by how much? By $2,600. So we can say that this is the balance carried down figure, right? So far the depreciation on this non-current asset. Further, it also says that Rod has the following depreciation policy for the office computer. Depreciation is charged at the rate of 25% using the diminishing or reducing balance method, very good, and Depreciation is charged for each month of ownership in the year of sale. So the method is reducing balance method and the policy is monthly basis policy. The rate is 25%. Right. What else it says? It says that all non-current assets disposals are recorded in the disposal account. Very good. And Rod sold the old office computer for $900, receiving the payment by check. Right. So these are what? These are the disposal proceeds. Now, what is the requirement? The requirement is to calculate the profit or loss on the disposal of old office computer. Right. So whether there's a profit or there's a loss on the sale of old office computer. We know that how do we calculate the profit or loss? You should have the T account, the disposal T account in your mind, right? Whenever you are asked to calculate the profit or loss, we know that cost comes on the debit side, the provision for depreciation accumulated comes on the credit side, and the disposal proceeds also come on the credit side. Now, if debit side is heavier than the credit side, then there will be a loss. A loss means what? A positive figure, right? If we are calculating profit or loss in the vertical way. And if the debit side is lighter than the credit side, then there will be a profit and that would be a negative figure in your calculation. So keeping this format in mind, we will calculate the profit or loss, right? So first of all, what is the cost of the office computer? The cost is $4,400. Okay, so $4,400 is the cost. Then we know that we will subtract the accumulated depreciation from this cost, so that we have the net book value, and then we'll compare the net book value with the disposal proceeds in order to identify, in order to calculate that whether there's a profit or loss. So less provision for depreciation. Provision for depreciation will be the accumulated depreciation on the office computer from the date of its purchase till the date of its sale, right? So we have the depreciation figure of 2600, right? Should I take 2600 as it is, or should I do something with it? Is this all the depreciation by which this asset has been depreciated till the end of its useful life or till the date of its disposal? No. 2600 will be taken, of course, because this is the depreciation till 31st of December 2018. However, the policy was to depreciate the asset till for each month of ownership in the year of sale. The year of sale is the next year, 2019, and the asset, the computer, remained in the business in that year for 6 months, right? So this means that 6 months of depreciation, additional depreciation, will also be charged on this computer, which will be in the year of its sale, right? So how can we calculate that? 2600 will be taken as it is. Then we will take the cost, right? The cost was how much? 4400. We will subtract the accumulated depreciation from the cost, because under reducing balance method, the depreciation is charged on the net book value. So net book value at the end of 2018 would be 4400 less 2600. Then on that net book value, we will apply the percentage rate, and that is 25%. But please don't forget to prorate this figure as well, as we are only charging depreciation for first 6 months, from January till June, right? So that would be an additional depreciation charge of $225, right? So 2600 plus 225 is the total depreciation on this non-current asset till the date of its disposal, right? Now what else we have to subtract? We have to subtract the disposal proceeds as well, and the amount was received through check. What was the value? It was $900. So subtract $900 as well, and then we will have 4400 less 2825 less 900 would be a positive figure, and that is what? $675, and that is what? A loss on disposal, right? Why is that a loss? This is because what was the net book value at the time of its disposal? 4400 less 2825. The net book value is 1575, right? So this was the value at the end of its useful life. However, we just sold it for $900, so we earned less from its sale. That is why there is a loss. Now we are done with part F as well. Let's move to our last part, and that says state the entries Rod would make in his accounting records on 30th June 2019 to record the disposal of the old office computer. So this is what the entries that you make in your disposal T account. We just have to write down those entries, right? So first of all, what do? We eliminate the cost from the cost account. And how would we do that? And how do we do that? We have already discussed that when we were learning about disposals. So first of all, we debit the disposal account, disposal of office computer. With what value? With the cost, and that is $4,400, and the office computer account will be credited in order to eliminate the cost of this account. So by $4,400. Then the next entry that we make is the elimination of the accumulated depreciation from the provision for depreciation account, right? So for that, we debit the provision for depreciation account. So provision for depreciation, and with what value? The full accumulated depreciation, and that is 2825, and we will be crediting our disposal account 2825, right? Office computer disposal account. And then lastly, we also record the disposal proceeds, right? The money which we received on that date, on 30th June 2019, and that was $900, and it was received through check. So bank will be debited now by $900, and our disposal account will now be credited with $900 as well, right? So this requirement was for 6 marks. So for each debit and credit, there is 1 mark, 1, 2, 3, 4, 5, 6. You don't have to make an entry for the loss, right? The entry would be credit disposal account and debit the income statement, because all the losses are debited in the income statement. But the requirement is that what entries will you make on 30th June 2019? So these 3 entries, the elimination of cost, the elimination of depreciation, the recording of disposal proceeds, these entries will take place on this date. However, the loss will be transferred on 31st of December 2019, right? On the last date, that is on the year end. So that entry will not be made over here. This requirement was for 6 marks, so 1 mark for each entry, right? So we are done with this question. It had a lot of parts. We saw that how do we make the disposal entries, how profit or loss is calculated, and it had a lot of theoretical parts as well. So overall, it was a good question. So that's it for this video. I'll see you in the next one.